Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Why Risk Parity Investing Matters, a beginner's guide. Mastering Risk Parity Investing, a modern approach to portfolio management. Imagine a way to invest that aims to balance risk, not just rewards. That's what risk parity investing is all about. Instead of focusing solely on high returns, it spreads investment risk evenly across different assets. Why is this important? In uncertain markets, it helps protect your portfolio from swings that can hurt your investments. You'll explore why more investors are turning to this strategy to manage risk intelligently. Understanding risk parity can be a key part of smart, modern portfolio management. Understanding risk parity. Risk parity investing takes a unique approach to managing your portfolio. Unlike traditional methods, where you might focus more on high-return assets, risk parity balances how risk is spread across different types of investments. This means thinking beyond just stocks or bonds, and considering how much risk each part of your portfolio carries. Let's dive into how this concept reshapes asset allocation and see how these ideas developed over time. The basics of risk allocation. In traditional asset allocation, investments are often divided based on potential returns. You might put a larger chunk into stocks if you aim for higher growth and allocate a smaller percentage to bonds for stability. But what if, instead of just dividing based on potential returns, you looked at how much risk each asset class contributes? That's where risk parity comes in. Risk parity aims to equalize risk across asset classes, so each part contributes the same amount of risk to the portfolio. Imagine you're building a tower out of blocks. Instead of stacking them haphazardly and risking a topple, you carefully balance each piece to make the structure sturdy, even if the blocks are different sizes. Similarly, in risk parity, each investment, whether it's stocks, bonds, commodities, gets balanced to maintain stability. To achieve this balance, investors use a mix of asset classes and adjust their allocations based on volatility. Here's how it generally works. Identify the risk level of each asset class. Allocate investing proportionately to balance the overall risk. Adjust regularly to keep everything balanced as markets change. This method leads to a portfolio where no single asset class overshadows the risk profile, offering a more stable investment journey. Historical context of risk parity. Risk parity is not just a modern buzzword, it has historical roots that date back to the late 20th century. The concept emerged in the aftermath of the 1987 stock market crash. Investors were keen to find ways to manage risk more effectively, and risk parity offered a promising solution. Pioneered by financial thinkers looking to stabilize portfolios during turbulent times, risk parity gained traction in the early 2000s. Notably, Bridgewater Associates, under the guidance of Ray Dalio, popularized this strategy. They demonstrated its potential to weather economic storms by equalizing risk rather than chasing unpredictable returns. As market dynamics evolved, so did risk parity strategies. Developments in technology and data analytics made it easier to quantify and manage risk, allowing investors to fine-tune their approaches. Today, risk parity is a key strategy for many institutional investors, prized for its ability to provide more consistent performance across different market conditions. How risk parity works. The mechanics of risk parity investing can seem a bit abstract at first glance. Yet, it's all about distributing risk evenly across different asset categories. Instead of guessing where the highest returns might be and stacking the deck in favor of those, risk parity aims to ensure no single asset class dominates the risk profile of your portfolio. Let's break it down into the key elements that make this strategy work. Asset classes and risk parity. Risk parity portfolios incorporate a variety of asset classes, each adding its unique flavor to the mix. Here's a closer look at the core components typically used. Equities. These are the thrill seekers of the portfolio. Stocks can offer high returns but come with higher volatility. In a risk parity setup, their risk is carefully balanced with other assets. Bonds. Think of bonds as the steady hand. They generally provide lower risk and more predictable returns. This stability is key in counteracting the volatility of equities. Commodities. This is where things get a bit spicy. Commodities like gold or oil can help hedge against inflation and market downturns, adding an extra layer of diversification. Each asset class plays a distinct role, much like the instruments in a symphony. Risk parity ensures they all contribute to the performance while keeping the overall risk in harmony. Risk contribution and leverage. Understanding how each asset contributes to the portfolio's risk is essential in fine-tuning your strategy. Let's walk through the process. Risk assessment. Start by determining how much risk each asset class brings to the table. You might use metrics like historical volatility to get a sense of the potential swings. Balanced risk contribution. Once you know the risk levels, adjust the allocations so each class contributes equally to the overall risk. This might mean investing more in lower-risk bonds and less in high-risk stocks. The role of leverage. Sometimes the only way to ensure this equilibrium is through leverage. It's like adding a dash of hot sauce to an otherwise mild dish. A little goes a long way. Leverage can amplify returns on those lower-risk assets without upsetting the balance. This process ensures that no single class monopolizes the risk, much like a skilled conductor keeping the orchestra in tune. The portfolio remains resilient through various market conditions, offering a smoother ride for the investor. Understanding risk parity means seeing your portfolio as an interconnected web rather than a random collection of investments. It's about knowing how each piece fits into the puzzle and ensuring no one part overshadows the others. Benefits of risk parity investing. Risk parity investing offers unique advantages for those aiming to balance their investment risks smartly. While traditional approaches focus on diversifying assets based on expected returns, risk parity emphasizes balancing risk across different asset classes. This strategy can be particularly beneficial during turbulent market conditions. Diversification benefits. Risk parity enhances portfolio diversification by distributing risk more evenly. What's the advantage of this approach? It reduces overall volatility, creating a more balanced and resilient portfolio that can handle market fluctuations. Holistic balance. In traditional portfolios, risk is often concentrated in a few high-volatility assets. Risk parity, however, spreads risk across different asset classes, just like spreading butter evenly on toast to cover every bite. This helps avoid the roller coaster ride that can happen when one asset class dominates your risk profile. Reduced correlation. By incorporating a variety of assets, such as equities, bonds, and commodities, risk parity exploits different behavior under various market conditions. This lowers the correlation between assets, creating diversification that acts like a safety net. When one asset dips, others may counterbalance it. Through these methods, risk parity can lead to more consistent long-term performance, mitigating the severe dips that come with concentrated risk strategies. Performance during market turbulence. Risk parity strategies often shine during periods of market stress. Why? Because they aim to ensure that no single factor dominates the risk landscape of your portfolio. Dynamic allocation. This strategy adapts to changing market conditions. In downturns, a risk parity portfolio might be weighted more towards low-risk bonds, maintaining stability while equity markets tumble. Historically proven stability. Over the years, data shows that risk parity often outperforms in volatile markets. Think of it as a well-tuned car. It handles sharp curves smoothly while others may skid off course. For investors, this can mean fewer sleepless nights and more predictable outcomes. When the market gets rocky, risk parity doesn't just weather the storm, it sails right through it, keeping your investments on a steady course. Risk parity investing isn't just a trend, it's a strategic approach that adds stability and clarity in an often unpredictable financial climate. By balancing risk smartly, investors can navigate both calm waters and stormy seas with greater confidence. Challenges and criticisms of risk parity. Exploring the intricacies of risk parity investing unveils some worthwhile challenges and criticisms. While risk parity offers insightful strategies for balancing investment risks, it's not without its hurdles. Let's look into the key issues that often arise with this approach. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.